Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here with you once again for our Charts of the Week segment for May 18th, 2020. Today we're going to spend a little bit of time talking about the labor sector. You see our disclaimer for important information. So as we look at the unemployment rate, I mean, we know that the data's been bad. We know that as we've been following it, that the data for last month was tremendously high, and frankly, could have been higher. It had certain things been calculated a certain way, but you can see in this chart that really dates all the way back from the end of World War II, the progression of the labor markets as we head into recessions and as we emerge from recessions, and this recession that we're undoubtedly in right now being very atypical in the sense that we essentially manufactured a shutdown of both demand and supply, which is really unprecedented. So you can see on the far right that our unemployment rate as it was determined in the month of April was 14.7%, and frankly could have been as high as 20 to 22%. Again, had certain things been calculated differently, but we thought we'd take some time and some charts that were produced by some research that was done by the Federal Reserve Bank of Dallas and some of their working papers on the labor economy, and they spent some time looking at some of the risk factors related to certain job segments, and so some of this is a little bit intuitive, but I thought it was worth going into here. Now, in this first chart that we look at from the Federal Reserve Bank of Dallas, it's a cross-section of industries, and obviously what we've seen here over the last few months is a considerable dislocation of workflows and sending people home, orders to stay in place, those types of things. And so a lot of industries have had to kind of adapt on the fly in terms of being able to work remote, work collaboratively, utilizing software platforms and things like that. And in a lot of cases, their companies are doing this for the first time, and so they're kind of learning as they go. But not all sectors of the economy are able to do that. And in this chart, it just really kind of highlights the fact that for more or less 29% of the U.S. workforce could work from home. This was a study that was produced by the Bureau of Labor Statistics American Time Use Survey. And this is data going back from 2017, 2018. And it just shows that 29% of the workforce could work from home, and that 39% of full-time workers hold remote compatible jobs. And so what does all this mean? It just simply means like financial services, which is our industry, BKA. Most of the things that we use in terms of software platforms and whatnot are all in the cloud, and we could be anywhere. We could be at home. We could be at home. We could be at a Starbucks. We could be at we could be off-site. Information technology, information processing. As you go from really left to right on this scale, you can see, on the left, those that are much more able to work remote and have workers actually be productive at home. Manufacturing a little less so than professional business services. Government employees, a lot of people from the Treasury, IRS, government agencies have been working from home. Education, when you start moving from the center of this over to the right, you can see kind of some of the natural impediments, and some of this is really intuitive. Natural resources and mining, construction, trade, transportation, utilities, and leisure and hospitality is really, kind of a boots on the ground, client-facing type industry, and it's extremely hard for people in that area to be able to work remotely. And in this chart, this shows kind of a bifurcation of Texas versus the rest of the U.S. in terms of the industries that are most susceptible to the pandemic and the disruption to the workforce. And if you look at the left-hand side, and this is really Texas, and the key difference is, as you look at Texas, versus the rest of the U.S. is that in the orange towards the bottom, that is mining, which is the oil and gas industry. Obviously, we have a greater share of that in Texas than the rest of the country. And also, if you look at transportation, we have an increased allocation of labor resources into that segment versus the rest of the country. So, as this chart might suggest, that that we have perhaps a greater risk factor here in Texas because of our incremental exposure to energy and transportation than the rest of the country. But needless to say that leisure and hospitality, trade, transportation, utilities, constructions, mining, which is oil and gas, that represents about 42% of the Texas workforce and about 39% of the U.S. workforce. In this chart, it analyzes really what percent of the workers in certain industries actually fall below the poverty level. And this is kind of a socioeconomic analysis that helps to drive home a lot of what we're seeing in terms of the unemployment figure that we saw on the first slide. Obviously, that the total number of unemployed, again, by the metric, the U3 number, the unemployment number that it gets published on a monthly basis. I mean, we know that that's over 14%, but we also know that there's a greater percentage within that number that are tied to some of these high-risk industries that we've been talking about. We know leisure and hospitality. We know natural resources and mining, certain degree education, certain degree construction, and certainly trade and transportation. With the really the decrease in travel and so on and so forth. But as this chart shows, that there is a greater preponderance or greater percentage of the share of the workers in those particular segments that actually don't have incomes that exceed the poverty line. In fact, the way to read this is that essentially, if you look at all across the board, that the average is about 10% of the workforce falls below the poverty line. Well, as you can see, at least in the U.S., which are represented by the red bars, that natural resources and mining, 12% of the workforce is above the poverty line. If you go over to leisure, which is probably the hardest hit area of the market, that almost 20%, whether you look at Texas or the U.S. as a whole, 20% of the workforce in leisure and hospitality, their incomes fall below the poverty line, which is tremendous because those are the people that are most impacted, as are the services, constructions, trade, natural resources and mining, and then education and health services. So, as we think about the aggregate number of unemployed, it's also important to know, who was already at risk, if you think about this going into this. And these were people that were already earning less than the median, earning less than the average, and already struggling to some degree despite the longest expansion post-war in history. So just a very, very important statistic to pay attention to. And this goes one step further and really just kind of adds on to the power of the data that was in the last chart. So not only do we have a lot of people unemployed, we have a lot of people unemployed in segments of the economy that are at or below the poverty level. A higher percentage of those employees are below the poverty level. And this just is another layer of this that intuitively you think that people don't have a lot of financial means, and there's a great percent of the people that work in leisure and hospitality, for instance, that don't make as much money. Well, in this case, this is just saying that they have a high percentage of those workers that don't have health insurance coverage, which, again, if you think about a weak economic period where people are struggling to make ends meet, even though they might have some short-term government assistance in terms of the increased unemployment benefits that were part of the CARES Act, that despite that, they're having, they could have tremendous strain financially from medical bills and other things that may come along that are really hard to predict at this point, but may develop for this cohort of the population going forward. So again, as we look at the fiscal stimulus, we know that it's a shot in the arm, but it's not a consistent drip, if you will, and we're going to have to find a way to defeat the virus, but at the same time open the economy, but also amidst all that, address kind of this large kind of subset of the population that's not only at risk, that has a higher percentage of their workforce that has incomes below the poverty line, and that also is going around without health insurance, where the tail risk is that you have large medical bills that are unpaid for, which has not only an impact on that particular person or family, but also it has an impact on the healthcare system as a whole. And this ties back directly to the costs associated with perhaps the virus itself, or even secondary illnesses that are a byproduct of the illness, if you will. But those are just some extremely interesting charts from some extremely interesting work that was done by the Dallas Fed that I thought was helpful for us to share with you. So with that, we will conclude for this week, and I hope you've enjoyed this presentation. And join us again next week for our charts of the week. And hope you have a wonderful week, and you see our confirmation, our information to reach us should you wish. Our phone number, email, and our website there. And we look forward to hearing from you should you wish to call. And otherwise, have a terrific week.